And joining us now on the debate in Berkeley, California, Lisa Margonelli, Director of the Energy Policy Initiative at the New America Foundation. In Houston, Texas, Amy Myers-Jaffe, a fellow in energy studies at Rice University. In Springfield, Massachusetts, Michael Lynch, president of Strategic Energy and Economic Research, Inc. In New York, New York, Edward Morse, energy economist who will join Citigroup as managing director and head of commodities research in May. And here in studio, Jeff Rubin, economist and author of Why Your World is About to Get a Whole Lot Smaller. Jeff, nice to see you again.
Good to see you,
Haven't seen you
Steve.
since we did a Monk's School show back
That's right.
a little while ago. And to our guests in the States, thank you very much for joining us. I want to put a graphic up to start things with here that you are all no doubt intimately aware of, but in case our viewers don't know, here's how the world's energy use unfolds. Latest figures available, 2007. This from the U.S. Energy Information Administration. Oil, number one, with a bullet. 35% of the world's energy use. Then comes coal at 27, natural gas at 23, renewables at 10, and despite what we might think, given all of the awful news out of Japan this past week, nuclear only represents 5% of the world's power mix. But Ed, let's start with you. What is it about oil that it apparently is still for us such an addictive fuel?
Well, we live in a world of transportation economics, and there's no substitute for oil on airplanes, in trucks, in cars, and on ships. So until there's a viable alternative, oil will be king.
At the start, Jeff, of 2011, how was the oil industry feeling about its position as the key provider of the world's energy?
I think the oil industry was wondering how it's going to keep pace with world demand that grew about double what the IEA and the other energy forecasts were forecasting. We ended up the year at a record 87.5 million barrels a day. World consumption increased by 2 million barrels a day. And when you consider that we lose 4 million barrels a day to depletion every year, that was a tall order. I think that was why oil prices were already at triple-digit levels even before the Arab uprising.
Amy, how would you answer that? At the beginning of the year, how was the industry feeling about the fact that it was the key provider of the world's energy use?
Well, I may disagree a little bit. I think we were, but for the Middle East turmoil, we were actually coming into a pretty surplus situation where we're having a lot of new oil come online, and we could see the outline of more oil coming from OPEC and in places like Brazil. And we were facing, a good growth in oil demand, but the possibility of a slower growth than expected in 2011. And so I do think Wall Street was very, very optimistic, and they were predicting $105 oil. And when they predict that, it becomes self-fulfilling because they tell all their clients to buy oil index funds. But had there not been unrest in Tunisia and Egypt, the market would have come back down because OPEC had a tremendous amount of spare capacity. They had 5 million barrels a day they could put out on the market. Saudi Arabia and its allies in the Middle East were committed to $70 oil, and they would have implemented that but for the turmoil.
Well, you've anticipated my next question, and I'll go to Lisa with that one. How has the conversation within the industry, Lisa, do you think changed regarding the future of oil, given all of the turmoil in the Middle East?
Well, I think that there are probably several different conversations going on within the industry, but I think for those of us here in the States, it's definitely changed to wondering whether the supply in the Middle East that we've always counted on since the 1950s, really, is going to continue to come uninterrupted. I think a couple of weeks ago, people would have said, well, there's some turmoil in Egypt, but you won't see this spreading to places like Libya. Libya is pretty much locked down, and now you have 1 million barrels a day of very light sweet crude coming off the market basically overnight in Libya, and scaring the markets, but also kind of giving us a foreshadowing of what may really be at stake across the Middle East, with Saudi Arabia sending troops to Bahrain, and a fairly heavy-handed suppression of protesters in Bahrain today. I think everything's pretty much up in the air.
Michael Lynch, how would you tackle that question? How has the conversation changed with all of the turmoil in the Middle East these days?
Well, people have worried about the Middle East for a long time. It hasn't been stable for, I think, the last 3,500 years. So, what's new is that, people are actually out in the streets having some success against governments, and a couple overthrown so far. But, you know, people really going back to World War II, as Lisa was intimating, is, you know, people have worried about relying on the Middle East or Venezuela or Russia for our oil supply. But we always have to remember these are generally transient events. At some point, the situation will stabilize and we'll be back to business as usual.
No pun intended here, Ed, but let me get you to drill down a little deeper on something that you wrote in Foreign Affairs magazine. Here's the quote. 2011, you wrote, might turn out to be as momentous a year for the global geopolitics of oil as was 1971, when Arab countries, of course, first began to significantly influence the price and the supply of oil. What did you mean by that?
Well, I think there are worries. There are new things on the horizon that we didn't see before. Amy and I, by the way, have both written, sometimes together, sometimes separately, on revolutionary change and oil production. And there's almost an inevitability when there's change in a society that's a major oil producer, that it either never regains its old level of production or it comes back to that level very, very, very slowly. So I think that's one thing to bear in mind. We're now seeing a whole new form of politics emerging, politics associated not only with the infection of mass communication, but communication about inequities, about old leaderships, about corrupt leaderships, about a distance between regular citizens and the leadership, and they're acting to change that. And that really is not only something new, but I think it's something that will be persistent on the horizon for the next decade, maybe even longer. And I think that, therefore, the risk profile going forward has been raised significantly.
Amy, I just want you to follow up on that, because I think you were at a conference in Houston this past week, or maybe it was last week, a significant energy conference, and I wonder what people at that conference were saying about all of what's going on in the Middle East and how it's affecting their industry.
Well, you know, the surprising thing about the conference is people were pretty myopic. And instead of taking the grand view that Ed just discussed, which I believe in, and you know, mirrors the history of the Middle East, when the last time we had a rise of Arab nationalism and revolutions that lasted for 2 decades back in the 50s and 60s, people were a little myopic. And indeed, a lot of the focus of the conference that you're mentioning was about the giant boom we're having today in natural gas in the United States. And people are very excited about that. They believe in that potential. People are worried about what the price of natural gas is going to be and talking about whether we could be exporting natural gas from the United States. And that discussion about natural gas almost overshadowed the speakers that were talking about the turmoil in the Middle East.
Jeff, is this industry in denial about what's going on in the world right now?
Well, first of all, the Middle East has not really been the source of new oil production for the world for the last 5 to 6 years. It's been places like Russia, it's been places like Canada, it's been places like deep water. I believe that most of Saudi's supposed 4 million barrel a day capacity is of the fictional variety.
What's that mean?
It means it doesn't exist. They may have 300 to 400 to 500,000 barrel a day heavy oil excess capacity, which is all that basically President Bush got when he went there in 2008 and pleaded with them to boost production when oil was $120 a barrel. On top of that, you've got a region of the world.
The Saudis just announced that they're creating a new light oil stream, and they've been offering it to customers in Asia. So that really isn't correct. They have a lot of capacity
announcements
there.
are one thing, production's
billions
another.
of dollars to build it up.
They have not been able to produce 10 million barrels a day for a sustained period for years.
Lisa, stand by for a second. You made your point. Let me hear what Jeff comes back with.
What I'm saying is, notwithstanding their announcements, Saudi has not been able to sustain 9.5 to 10 million barrels a day production for years. And even when President Bush went there pleading in 2008 to boost production because oil prices were already in triple-digit range, all they were able to produce was another 300,000 to 400,000 barrels of heavy sour oil that most of the world's refineries couldn't even handle.
Okay,
that's the historic record.
Amy's on one side of this, you're on the other. Let me get Michael Lynch to come in here and play referee a bit. Michael, whose side are you on this one?
Well, I'm going to have to side with Amy. I mean, there have been people like Jeff and Matt Simmons writing about Saudi oil for some years, and the Saudis have repeatedly outperformed what the critics said they could do. They do occasionally look out in the market and say prices are high, but inventories are high, so we don't want to create a glut in the market. They have produced at 11 million barrels a day just a couple of years ago, in fact, which supposedly they could not have, physically accomplished, but they did it. So there's oil out there. Just because we can't see it on a day-to-day basis doesn't mean it's not available.
Jeff, let me see if Lisa might be an ally of yours on this one. Lisa, where are you coming from on this issue?
The Saudis have fairly consistently put out what they've said that they would put out. What I find troubling is we're not just talking about what's going on in the Middle East. I think that there are other conversations going on, for example, in Nigeria, where the militias have a history of attacking the pipelines, and watch the oil markets quite carefully. You see that in the last 2 days, MEND, the largest militia in the Niger Delta, has been threatening to attack 3 different pipelines around Nigeria. And the Saudis may be able to ramp up capacity yet another 1 million barrels a day after the loss of the Libyan oil. But are they necessarily going to be able to make up another supply shortfall that comes on because of a shutdown in Nigeria? These things tend to sort of snowball, and as the prices rise, the stakes of more players getting involved in the market tend to rise. You also have Iraq was one of the big hopes for increasing Middle Eastern oil production this year, and within the past week you've had 2 attacks on pipelines there that have shut in, I think, 1/4 of the country's exports. And you also have a large attack on a refinery.
Ed, whose arguments are you finding more persuasive here?
Well, I'm with Mike and Amy on almost all the issues. I think I think we have to remember that the Saudis, like all governments, are always fighting the last battle, the last war. And the last war that they're fighting in many ways is what happened in 1997, 98, 99, when the price of oil plummeted below $10 a barrel. And it's that period of time where they saw that their production was fighting inventories that had accumulated. And as Amy and Mike both indicated, they look at inventories every single day, and they're fearful of creating something that's going to get out of control on the downside. That might not be right, but that's what they're fearful of.
Jeff, you want one more chance to make your case?
I think what viewers got to ask themselves, because they hear different experts saying different things about Saudi production, prices do the talking. World oil prices, which is the Brent short-dated futures contract, has been over $100 since the 2nd week of January. If Saudi Arabia does have this supposed excess capacity, and if Saudi Arabia supposedly is interested in keeping world oil prices from getting to levels that create a world recession, why are world oil prices still at triple-digit levels? I think that's a question that increasingly most viewers are going to be asking themselves.
Amy, if they're asking themselves that question, what kind of answer are you going to give them?
Well, in 2007 and 2008, we sat down here at the Baker Institute at Rice University, and we compiled statistics on who was in the futures market. And it showed a tremendously dramatic shift. Prior to 2000, what we call industry hedgers, that's people like your airlines, your heating oil distributor, oil companies, represented a large part of the market, and financial players were only 20% of the open interest, in other words, the number of contracts being held. By the time we came to 2007, we're talking about 60% of the open interest contracts in the oil futures market were being held by your bank, your pension fund, sovereign wealth funds in the Middle East. So it's really a financial play. And you see a lot of people trading oil where they're spreading against not whether Saudi Arabia's announced they're replacing the oil, because we had 1 million barrels a day more oil in the market in the month of February than we had demand, and 2 million barrels a day more in the market in January than we had demand. But, your pension fund wants to go long oil because they believe they'll make the most money doing that for you. And that is why the price of oil is not coming down, and that is what Saudi Arabia has to try to manipulate when they try to deal in the fundamental market for real oil.
Jeff, just take 30 seconds here and help us with something, because you've said that the Brent price is over $100 a barrel.
No, that's right.
But I guess the sweet crude from West Texas, which is what we've usually
that's right. There's a whole bunch. There's
a
whole bunch of oil piling up in the middle of nowhere, in Cushing, Oklahoma, which is totally disconnected from world markets. And a good part of that oil piling up there is coming from the Canadian tar sands, and also from the Bakken shale oil deposits in the Dakotas. And it's piling up there faster than Midwestern refineries can handle. And that's why West Texas is $10 to $15 cheaper.
Gotcha.
But if you go down to Louisiana and you start buying the oil that comes into the U.S. ports, it's not priced at West Texas, it's priced at Brent. And when you look at U.S. gasoline prices right now, it's a lot more reflecting what's happening in Brent than in West Texas. And Brent's been over $100 before protesters swept into Tahrir Square demanding Mubarak's head.
Okay, let's talk, since you've brought the issue of politics back to the table here, let's follow up on that. We're going to call this next section of our discussion a problem with politics. And to that end, let's bring up the following graphics. Here's the proven oil reserves in the world by countries. Number one, not surprisingly, Saudi Arabia. Number two, us, Canada. Number three, Iran. Number four, Iraq. Number five, Kuwait. Number six, the United Arab Emirates. Number seven, Venezuela. And number eight, Russia. That according to the CIA World Factbook. Now we're going to keep those countries, and then, Michael, let's bring up this next list as well, because this shows you the politics of what the world is trying to deal with here in terms of where we're getting our oil. Bring that next graphic back up, and here's Saudi Arabia, not a free country. Canada, yes, of course, not only a free country, but the greatest country in the world. Iran, not free. Iraq, well, technically not free, but getting there, I guess. Kuwait, partly free. United Arab Emirates, not free. Venezuela, partly free is the estimation of the CIA. And Russia, not free. Again, that's according to Freedom House. Okay, we can see what's developing here. We've got a significant amount of the most important resource of the world in the hands of countries that Freedom House, at any rate, considers to be not free. So, Lisa, come on in here first on this. How does the so-called not free nature of many oil-producing states complicate supplying the world with oil?
Well, there's definitely a correlation between countries that export a lot of oil and their sort of not freedom. I mean, the concentration of revenues and the way that they come into the government, and the government's sort of focus on distributing revenues and keeping other competition, or political and economic competition out of their way, kind of tends to make these countries more autocratic. At the same time, the countries have such a dependence on that oil stream that they will do anything to keep the oil flowing. So, I think for the United States, one of the reactions to the uprisings in the Middle East has been, how is this? Why are we paying a price suddenly for these uprisings? And I think we need to ask ourselves whether we've actually been getting a discount over the years on account of the autocratic regimes there that have essentially assured that outflow of oil. It makes the whole, the politics of oil become very, very complex when you're dealing not only with the global politics of the oil flow, but the internal politics of that country.
Ed Moore's going to get you to weigh in with why this free versus not free index is of so much concern as vis-a-vis the supplying of oil to the world?
Well, I think we know why it's of a concern. It's concern because of a whole bunch of factors, including the uses to which the money is put from oil revenue, including the likely instability ahead as a result of income disparities and the inability to deal with unbelievably young populations and very high unemployment rates that are reaching 30 or 40% of the young population in most of these countries. So it's not surprising that we're seeing what's happening unfolding. I would like to say a word when you get a chance to get back to the $100 price, because I think there are some really underlying fundamental oil reasons why oil was at 100, forgetting about the peak oil views one of us has.
Okay, hold that thought for a second. Well, we may come back to that, but I want to stay on this issue here, on the issue of free versus not free. Michael, let me bring you in at this point. Many of these countries upon which we are dependent for our oil are not very transparent at all and quite corrupt in the way they do their business. How does that complicate this whole situation?
Well, it's not just the question of these regimes being corrupt, but the importance of oil, because it represents very concentrated wealth. And, you know, I will, as a corollary, remind you, we in the U.S. used to have trouble with a guy named Pierre Trudeau, you may have heard of, who said, you know, the problem is we're exporting all of our precious mineral resources, energy resources to those awful people south of here. We need to keep the stuff in the ground, and we need to buy out all their upstream investment. That didn't work out so well for him, and in fact his successor pretty much reversed those policies. So the point is that oil is a very political commodity, and as such you run the risk of, for example, the U.S. declaring an embargo against your oil industry, or the Iranians deciding they're going to shut down in support of the Palestinians, something like that. So it's not just the corruption and the opacity in some countries, it's the fact that this is a very much used as a political weapon from time to time.
Amy, you want to come in on that?
Well, you know, let me also add on this question of free, not free, because we here in the United States, and I'm sure many citizens in Canada, are rooting for these demonstrators to have a more normal life and more voice in their government, and have the oil revenue be distributed in a more fair and equitable fashion. But the experience we know is that democracy is a messy thing, and because of our democratic process, we spent a year in the United States debating whether or not to let our companies drill offshore in the Gulf of Mexico, and we're seeing the same kind of thing in Kuwait. They have an active parliament. It's a very assertive parliament. They decided that they want to keep their oil in the ground and not let foreign oil companies come and develop their resources, and as a result, expansion plans that the so-called monarchy might have done in 1 minute back in the day have been delayed for 10 years. So when we think about free, we have to remember that that means everybody can vote. And when people can vote, they might vote for a higher price of oil, not a lower price of oil. They might vote to leave their oil in the ground or not leave their oil in the ground. They might be more concerned about environmental factors. They might be more concerned about corruption. There might be a lot more transparency, and that might slow things down. And although that's good for, you know, world society and maybe stability over the long term, in the short term, that might not be good for Western drivers, because it might mean more shortages for us in the short term, not the long term.
Well, Jeff, that's a good point. We often talk about you know, technical problems in terms of trying to get future oil supply. You know, how difficult is it to get the tar sands going, the oil sands going? But how much of the challenge regarding the future supply of oil is actually political, not technical?
Well, you know, I think when we're talking about the Middle East, a much bigger challenge is, apart from regime change, is how much of the oil in the Middle East is going to be consumed in the Middle East. Because nowhere is the demand for oil growing faster than it is in the very countries that we're depending on. For example, the Middle East, okay, is already consuming almost 1/3 of its entire oil production. And even the president of Saudi Aramco said recently that at its present rate of oil consumption, Saudi Arabia is going to be consuming 7 to 8 million barrels a day by 2025, in which case, even if you believe your guest's estimate of their excess capacity, isn't going to leave a whole much more for export. So, you know, while we're all focused on how much is the Middle East producing, what we lose sight of is how much is the Middle East exporting, and every year that's less and less, not so much because of depletion, but every year the Middle East is consuming more and more of their 40-cent a gallon gasoline.
Let me invite Ed to come in at this point and follow up on the comments you made a couple of minutes ago about factors that go into the cost of oil. And I wonder how much of the, you know, what I think most people consider to be very high price of gasoline, of oil these days, is a risk premium.
Yeah, I think there are a couple of premia that are on the price. One of them is a measure of risk. One of them on the cost issue, just following up on what Jeff said, is that as a result of these civil disorders that we've seen across the Middle East, North African region, the break-even price of government budgets is going up, which means that from a producer government perspective, the requirement is for a higher and higher oil price, not because the cost is going up, but because the budgetary requirements are going up. But I think there is a premium. I think if you look at where prices were heading in the middle of January. They were heading down. Brent might have been at 3 digits, but prices were heading down. And they were heading down for the reasons that Amy had indicated. I think that one of the reasons the prices were where they were is reinforced by what's happening in Libya, namely that there was a truly unusual spike in demand for a relatively low sulfur diesel for a whole bunch of extraneous non-normal reasons, including the coldest winter in 30 years in the Northern Hemisphere, which skyrocketed demand in Europe and the US and Canada to some degree. We saw a strike in France over raising the age of retirement by 1 year, which resulted in a loss of some 60 million barrels of petroleum product, including over 30 million barrels of the gas oil needed for heating. And we saw the Chinese government, not mindful of what the impact was going to be, deciding that it was very important for them to reach certain energy and efficiency targets by the end of their last 5-year plan, which coincided with the end of the last year. And that resulted in reduction in coal burning in power generation plants, an interruption of power transmission, and a surge in demand for diesel on power generators, small power generators throughout the country.
So the list is long.
There was a real, and then the Libyan oil is oil that is very rich in distillate, very low in sulfur, and has extended this shortage that was created by unusual one-off events in the last quarter of last year.
Okay, Amy, I'm going to get your comment on this first. I want to read a small excerpt from a piece that Steve Levine did of Georgetown University's Security Studies program. He's writing in foreignpolicy.com, this from just yesterday. Over the last several months, we've learned the hard way, in incredibly coincidental events, that we are in firm control of almost none of our major sources of power. Deep water oil drilling can be perilous if the company carrying it out cuts corners. Because of chronically bad governance by petrostates, we can't necessarily rely on OPEC supplies either. Shale gas drilling may result in radioactive contamination of water. As for much promoted nuclear power, we know now that big, perfect storm, black swan natural disasters can come in twos. It seems, as our conversation continues here, Amy, that all of our major energy supplies, in one way or another, have become politically difficult, and we all know that renewables are not going to get, renewables are not going to be able to dominate the energy landscape in the way that many people would like them to in the next 5 years. So, having said all that, what's the least worst option today?
You know, we actually have a lot of good options, and we have a lot more options than we did in the 1970s, so I would say the industry is in a better position. The first thing we need to wrap our brain around is if gasoline prices are going to go up, and that's going to hurt Detroit again, next time when we bail them out, we need to tell them exactly what kind of cars we want them to make to help the world. And those are cars that are highly efficient, that maybe utilize more electricity resources. That technology is coming. It's already on the market. So just the 2007 United States corporate average efficiency standards that have been passed are going to eliminate 3 or 4 million barrels a day of oil demand over the next decade. If the United States made a push to electric cars, because we need to remember we don't use oil basically in our electricity sector, that could eliminate another 2 or 3 million barrels a day of demand. So our biggest tool that we have is regulating the car industry. I have this fun fact I like to tell. If we were serious in the United States, like the people in Japan were very serious this week in lowering their energy use, in the United States, if every American were to eliminate 35 miles of driving per week from their daily routine, whether they telecommuted, used public transportation, consolidated their errands, carpooled, we could lower oil demand in the United States by 20% doing nothing except that. So that is our first line of action. 100% has to focus on that. But, you know, I have faith in the industry. You know, we had this terrible accident in the Gulf of Mexico, and within a year, the industry came up with a containment technology that means that if there was a future such accident, they could collect the oil quickly in 3 days, right? I believe if we had proper regulation, whether it's for drilling for shale gas, whether it's for doing unconventional oil in the Bakken or in Wyoming for oil shale, that if we had the right regulation, I have faith in the engineering skills of the people in the oil industry that they can come up with ways of doing all that that's not environmentally harmful, and we could have a tremendous uptick in production in the United States of millions of barrels a day of new unconventional oil if we would just get the regulations correctly.
All right, let me go to California next. Lisa, why don't you weigh in on that as well and tell us, you know, if we get the impression right now that most of the options we see out there are lousy. I know Amy doesn't share the premise, but humor me for a second. What's the least worst option there?
Well, our least worst option is really energy efficiency and conservation. I mean, it's exactly what Amy talked about. But the problem is we may have the ingenuity in the industry and we may be able to respond, but we actually need the policies. And we have this kind of ball of a policy kind of roadblock going on in Washington where the Republicans and to some extent the Democrats have also kind of abandoned climate change legislation, which was a way of creating new markets and pricing in some of the externalities of fossil fuels. And at the same time, they're fighting against things like energy efficient light bulbs. The hearing that was held this morning on nuclear power with the DOE head, Stephen Chu, started off with kind of a lecture by the head of the committee talking about how we needed to stop funding energy efficiency. We actually need to push ahead with the energy efficiency. We need to just put the screws to Detroit if we're going to have an auto industry 10 years from now. And frankly, we're in a rather scary time because we have, I think more and more people are having a visceral reaction to the energy that they use. They looked at the oil-coated birds in the Gulf and they went, huh. And they're doing the same thing. They look at the TV and they see these meltdowns in Japan, or the partial meltdowns or whatever these things are, and you get this kind of huh feeling of dread, but that's not actually, we're not putting that to productive political use and getting the policies in place that would allow us to do basically the work that we have to do.
Jeff, I was under the impression that when the governments decided to become owners of General Motors and Chrysler, part of the deal was they had to move much more rapidly towards these kinds of energy efficiency methods that Amy and Lisa have just talked about. Was that not the case?
Well, at the end of the day, Chrysler and GM are going to be dictated by the market. But I think, where you're saying, where is this ultimately going? Where this is ultimately going is that we're going to end up using less energy and we're going to end up burning less oil. And oil prices are going to march to levels that are going to induce another global recession. And in the aftermath of the last global recession, guess what? Global oil consumption fell. And that's exactly what we're heading for in the next year and a half. But I think, instinctively, we always want to see the solution as some form of supply. But the answer is really on the demand side. So instead of trying to figure out how to turn cow dung into high octane fuel, we're just going to have to learn to get off the road.
Michael, what do you say to that?
Well, obviously I disagree with Jeff, and I guess Steve Levine's point is, life stinks and then you die. There's costs everywhere to everything, risk and problems. My local Whole Foods market has carrots delivered by bicyclists, but since he's not a vegan, I don't buy them. The fact of the matter is, oil has very good uses. I agree that efficiency is our best alternative, and it's generally speaking very cost effective. The big issue, though, I think, is to what extent do we let the government make decisions, recalling that governments have made a lot of bad decisions, like Jimmy Carter pushing shale oil, for example, the French pushing nuclear power, you might argue against. So to have the government, the auto industry's problems were really its inflexibility to meet changes in the market. And if all they're going to make are 50 mile per gallon econo boxes in 5 years and the price of oil goes back to $40, then the auto industry will get creamed again as the Japanese bring in SUVs.
But Ed, can it be bad government policy to push energy efficiency? I mean, that doesn't seem like such a controversial thing.
It's not such a controversial thing, but you can't get government consensus unless you give a little bit to all of the parties, and it's been a very hard political bargain to get. I would note that last Friday, when the President Obama gave a press conference where the disaster in Japan was being discussed, he talked very positively about not only energy efficiency, but the need for a massive supply-side response. He was very positive about deep water. He was very positive about unconventional oil, and I think that in part is a recognition on his part probably that you need both in order to get a transition into the future, into a future where energy efficiency will have to dominate.
We've got about 5 minutes left here, and I want to put one more thing on the table. In spite of all of the optimism I'm hearing at this literal table in Toronto and our figurative table in Points Beyond, here's what Shell, one of the biggest oil companies in the world, has on its website, published a couple of years ago, but it's called the Shell Energy Scenarios to the Year 2050. And here's an excerpt. In one scenario, they write, a typical three-step pattern begins to emerge. First, nations deal with signs of tightening supply by a flight into coal and heavier hydrocarbons and biofuels. Then, when the growth in coal, oil, and gas can no longer be maintained, an overall supply crisis occurs. And finally, governments react with draconian measures, such as steep and sudden domestic price rises or severe restrictions on personal mobility with accompanying disruptions in value chains and significant economic dislocations. By 2020, the repetition of this volatile three-step pattern in many areas of the energy economy results in a temporary global economic slowdown. Amy, let me get your take on this. How credible a scenario do you think this is, put forward by, as I say, one of the world's major oil companies?
Well, you know, it really, I think it really depends on your point of view. That scenario is I would say it's sort of a global warming oriented scenario in the sense that the idea is that government is going to step in and tell its citizens how to use energy and whether to, you know, have human mobility. But, you know, you can see something like that. I don't think it's a likely scenario, but if you look at the state of California and some of its policies that they've tried passing, and sometimes they can't implement them, but they pass them, some of them are actually quite draconian in what they want to require people to do. So I think the question is, you know, what's the impact over time? Because 2050 is a long time. So in the next 10 years or 15 years, do I start to see much more extreme weather? Do I link that to carbon emissions? How does the public feel about that? You know, in the last year, at least here in the United States, there's been this sort of mental move away from worrying about global warming. But, you know, generationally, I mean, I'm talking to you all from a university. I mean, generationally, I don't see that movement. I see it in the polling numbers in the United States, but I don't see it among 18-year-olds.
Understood.
18-year-olds are very climate-oriented.
Michael Lynch, let me hear you on that one.
And so the question is, what will
Sorry, Amy, let me jump in because
their generation put forward?
I hear you. We're only got a few minutes left. I want to make sure we get to as many as we can here. Michael Lynch, what do you say on that question?
Well, I've seen an awful lot of scenarios, energy scenarios in my career, and nearly all of them have proven to be not just wrong, but foolish. I think that's a very low probability case. I think 5 years from now, we'll find that the industry and the market, and 20 years from now, it's not that different. There will be technological advances, but we'll all still be driving gasoline and diesel cars.
Jeff Rubin, that scenario for you?
We'll see that scenario play out, or some variation of that scenario, very shortly. In the next couple of years, we're going to see world oil prices above $147 a barrel. We're going to go into another oil-induced recession, and I think that's going to redefine the very nature of economic recovery. Certainly, energy rationing, either by the market or the state, is going to become a permanent feature of our future economy.
You said $200 a barrel once upon a time. You're still sticking with that?
And, you know, we saw Brent at 120 a couple of weeks ago, but what's particularly poignant is that these prices are the prices at the beginning of a cycle. It took 8 years of economic growth to get us there last time. We're already there after a year and a half. What does that say about the sustainability of the expansion?
Ed Morse, you want the last word on this?
I'm happy to have the last word. You know, what if the China miracle ends? What if the Chinese government confronts a major financial crisis and that the house of cards of the financial system goes under and this incremental demand that we've been worrying about disappears? I'm with Mike Lynch on this subject. I'm a believer in technological change and costs coming down and supply being ample.
I want to thank all of you for participating in this most interesting debate tonight. Thanks so much to Lisa Margonelli from the New America Foundation in Berkeley, California, Amy Myers-Jaffe, Rice University in Houston, Texas, Michael Lynch, Strategy, Energy, and Economic Research, Inc. in Springfield, Massachusetts, Edward Morse, the energy analyst out of New York City, and Jeff Rubin, why your world is about to get a whole lot smaller. Thanks so much, everybody. Great to have you on the program tonight.